Hello everyone, welcome to today's lecture. So today I'm going to discuss about rest of the 500 series of essay, and we will discuss essay 532, different 500 series and with their descriptive questions and MCQs. Yesterday what we did is we discussed essay 501, 520, then 510, different essay 505 in detail, and accordingly we also solved their questions. So you can ask any doubt if you have from those essays or from any of the previous essays. I'll be happy to solve it. Okay, so let's start the today's lecture. So today I'm going to start with essay 530, audit sampling. Now, before we deep dive into the particular standard, what we need to understand is what is the objective of this particular standard, and what is the scope of this particular standard, like why we have this particular standard in the list. See, there is an inherent limitation with respect to the audit that you cannot perform 100% audit. Okay, you cannot. There will be something that will be, there might be some risk which you cannot address till. You need to accept that particular risk, which is below the acceptable level. Now, when a risk is below the acceptable level and you accept it because of the inherent limitation of the audit, at that point in time, what we do is we perform the audit on the sample basis. Okay, we select these samples, we test these samples, and accordingly we give our conclusion based on the conclusion of the samples. So when I talk about the scope of this particular standard, this standard deals with the when the auditor has decided to use audit sampling in performing the audit procedures. Means when an auditor decides, okay, now he will use sampling, audit sampling, at that point in time this standard will come into the picture. Okay, it deals with the use of statical and non-statical sampling. Now, what is statical sampling? We will see the type of sampling, statical and non-statical sampling, when we continue with the particular standard. Okay, but it deals with the use of statical method and non-statical method when designing and selecting the audit sampling. So it talks about both. Then this particular standard complements the 500 series of essay 500 audit evidence. Okay. Why? Reason because when auditor is dealing with the audit sampling, this standard requires the auditor to design and perform audit procedures to obtain sufficient and appropriate audit evidence. Again, essay 500 says that auditor needs to obtain appropriate and sufficient audit evidence. This says that how you can obtain appropriate and sufficient audit evidence by audit sampling. So that's a complementary to the 500. Okay, and the objective again is when the auditor is using audit sampling to provide a reasonable basis of audit opinion to draw the conclusion about the population. So then at that point in time it guides the auditor how to perform the audit sampling and draw the conclusion. So basically, it talks about audit sampling and guides the auditor how to use the audit sampling, how to gather the audit evidence through audit sampling. Let's see, when the scope, when the auditor has decided to use the audit sampling, statical and non-statical sampling in performing audit procedures and to provide a reasonable basis for the auditor to draw the conclusion about the population from which sample is selected. Now, there are few things that I want to discuss before we jump onto the detailed requirement. So, there are few definitions. Like first, audit sampling. Simple. It's pretty simple. That the audit procedures that we apply to a particular sample, which is not 100% of the population. Okay, that is audit sampling. So, what is the definition which is given in the standard? It's that the application of the audit procedure to the less than 100% of the items. Obviously, like if you have selected certain items, when you apply that audit procedure to those items, those are the audit samples, and that will be less than the 100% within a population of audit relevance, such that all sampling units have a chance of selection in order to provide the auditor with a reasonable basis to draw the conclusion about the entire population. Okay, means that whenever we select a sample, we select a sample in such a way that each and every sample has an equal chance of selection. Okay, or all these sampling units have the chance of selection. If it is a statistical method, risk based, or there are multiple, sample selection methods. So means that each and every sample has a certain chance of selection. Now that certain chance of selection will depend upon the type of the method of the sampling. And in random sampling, they have a equal chance, but they have certain chance of selection in order to provide that the auditor with a reasonable basis that, okay, now I have selected the sample. Now I can, on a reasonable basis conclude that whatever I have, drawn from the population, that the 10% or 20% or whatever sample it is, and the conclusion about those samples can be reflected on the population. Then the sampling risk. The risk that the auditor the auditor's conclusion based on a sample may be different from the conclusion of the entire population. So whatever entire population it is there, if let's say for example, I'll give you one good example for this. Just a minute. Okay. Let's say for example, you have a population. Okay, I'll draw a population circle. Now let's say I have this population with me. Now I have selected certain sample from this particular population. Now this sample from the population may not represent the whole population. So the audit risk is that whatever sample I'm selecting, okay, let's say this is sample 1 and this is sample 2. Now if I select the sample 1 which does not represent, so let's say for example population is circle. Okay, and if I select a sample which is representing a square property, means this sample does not represent the population. The population is a circle shape, but my sample depicts it's in the square shape. So the population and the sample does not match. Hence, there's a risk that okay, whatever population or whatever sample I might select, it may not be representing the whole population. If this whole circle is there, if I cut a piece of this circle in a square shape, can I say that circle is a square? No. I have cut the piece in the square. That doesn't mean circle becomes square. I have cut in a wrong shape to represent a circle. So there is a sampling risk that the sample that I have selected may not represent or may not depict how the whole population it is. Okay, if tomorrow I bring that cutout piece of that particular circle in a square shape and I say, see, this is the whole circle look like. This is a small piece which I cut it out from that particular circle, but this is how the circle looks like. That's not the appropriate way to represent, because someone will think, okay, this is a square circle. He's saying circle, but that might be a square. So there is a sampling risk. Okay, now sampling risk can be of two types basically. Now the first type of sampling risk is that the controls, usually in the test of controls are more effective than actually they are. Okay, in the case of test of details, it appears that the material misstatement does not exist. Okay, when in fact it does. So usually we call it, this type of particularly issue when we the things are there but they are not appearing on the face. Things are there but they are not appearing on the face. Okay, so we call it false positive. So either it is false positive, that okay, like you have received that there is a positive, means there is no observation, but in actual there are observations. So your sample testing shows no observation, but your actual scenario or actual factual, or you can say actual scenario says yes, there are observations. So that's the false positive. Now second type is your false negative. False negative means in your sample testing, you get observation, but actual scenario, there are no observation. And why you get the observation in sample testing? Because same way, this way. Let's say for example, I selected certain sample and I want to match that whatever sample I have selected should be equal to circle. But when I saw my population, it was a square. Or when I saw my sample, it was a square. It was not matching to a circle. And hence I concluded that is an observation because I expected to be a circle. But in actual, the population is circle. I am seeing a limited thing. My view is limited. Hence, I am not able to conclude appropriately. That's why I am saying it's an observation that is false negative. Clear? Any doubt till now with respect to the sampling risk? This is the sampling risk I'm talking about, the type of sampling risk. Shailendra, can you rewrite your query about SF 526? I just want to understand further on this. Okay. Meanwhile, get any other query, I'll proceed. Okay. Now, that is something we were talking about, sampling risk. What is sampling risk? That the auditor's conclusion based on a sample may be different from the conclusion if the entire population was subject to the same audit procedure. There are two types of sampling risk, false positive and false negative, that we discussed. Okay. Now comes the third part, is an anomaly. Anomaly is a misstatement or a deviation. Okay. Anomaly is a misstatement or a deviation that is demonstrably not representative of entire misstatement or deviation in a population. Means, let's say for example, this whole population is there. Somewhere in this population, I have a misstatement. But that is a unique case because population can consist of a large number of things, a large number of transactions. Let's say these all are sales transactions. Okay, and this was, let's say, sale to top 10 vendors. This was, let's say, random cell selection. Now, somewhere in this entire population, there was one consignment sale. Okay, there was one consignment sale. Sale on consignment basis. That was the only standalone transaction, or let's say, few transactions, very few. Now, this consignment, sale on consignment basis, I found some small error or small misstatement. Can I say that this particular misstatement is representing the whole population? Answer is no. Reason because I cannot apply this particular misstatement to the entire population. Reason because there are few transactions or only one transaction of such nature. Means a misstatement or a misstatement or a deviation that is demonstrably not representative of the misstatement of the entire population is anomaly. Means that the time when you cannot, apply this particular misstatement to the entire population, that's an anomaly. That's not an, extrapolation or representative misstatement of the entire population. So I think your query is false positive sample is related with any particular organization. No, as such, it's not related with any organization. False positive or false negative, it's a type of sampling risk that, you might get a false positive, that positive assurance that everything is right, but in actual things are not right. Or false negative is you get a negative assurance that, okay, things are not appropriate or not right, but in actual they are right. So it's not related to any organization, it's a particular situational. Okay. So that was about the sampling risk that I was talking about. Very important concept, very, detailed concept, but good to understand. So there we had anomaly, and we cannot, project an anomaly onto entire population. Okay, good. Now, let's say, for example, you are going for now sampling and you are doing sampling. Okay, so what things you need to consider while performing the sampling, that's very important. So when we are, performing the sampling procedure, we need to take care of certain things. Okay, like, how we do sampling, how we select samples. There are many things that we need to take care. Those includes, okay, I have created a short wordings for that. TCSCMR. That is, you need to consider about TCSCMR. That is the purpose of the audit procedure. Why you want to consider why you want to have this particular audit procedure. Okay, the purpose of the audit procedure will help you to decide how much sample you need to select, how the testing you need to perform in detail. Okay, then characteristics of population. What population is made up of? Sample size. Okay, now sample size, how much sample size you should take to, to reduce the sampling risk at a low level. Okay, that will define, that will help you to understand, okay, this is the thing that you need to take care. Okay. You need to ensure that each sample has a chance of being selected, the chance of selection, basically. Then you need to consider what is a deviation or misstatement with respect to the sample. Very important part. Most of the people, miss this particular point. Let's say, for example, I have selected a sample out of this circle. I need to decide what is the deviation, first of all. What I'm looking here. Okay, let's say, for example, if I take a chunk out of this circle, I can say, okay, for a deviation, to identify a deviation, I need to define the deviation. Let's say, if I want to say something is wrong, then I need to define what I'm looking for, what is wrong, basically. So when I'll take out a chunk of this particular circle, let's say I'm checking whether this particular chunk is representing or in the circle shape or not. Now, if it is not in the shape of circle, that's a deviation. That is something I have defined the deviation over here. So you need to define the deviation, and then the sample should represent the entire population, same characteristics. If the entire population is circle, your sample should also represent a circle, not a square. So these are the things you need to consider while performing the sampling. So sample size, sample. Then when you perform the audit procedures which are appropriate for the selected items, okay, then you need to think, okay, these are the samples I have selected. Now on these samples, whatever audit procedures I will perform, that will be like, based on the selection criteria that will be there. Now, what if the audit procedure is not applicable to that particular sample? Let's say, for example, I wanted to have only sale on consignment basis, but when I selected the population, some normal credit sale also came into my sample selection. At that point in time, what I'll do is, if I cannot apply the procedure to a particular sample, or if the procedure is not applicable to a particular sample, then I need to select another sample. If I'm unable to apply procedure, okay, if I'm unable to apply procedure or unable to test, then consider the sample as a misstatement or deviation. Now I'll say, what is the difference between second number point and third number point? Very big difference. Number one, second number point talks about when the procedure is not applicable. I'll show you here. Simple. There is a very big difference. When I say procedure is not applicable, that means the sample does not belong to the category for which the auditor is performing the testing. Let's say, for example, I was testing only sale on consignment basis. And in that, if I have a sample, if a sample of normal sale comes into the picture, then that sample of a normal sale will represent, okay, procedure is not applicable to this particular sample because I am going to test consignment sale, not the normal sale. Now, cannot apply the procedure. So in cannot apply the procedure, your sample is correct and it represents the selection criteria. Or you can say it fulfills the selection criteria. Okay, represents or fulfills. But due to some factors, auditor is not able to test. For example, missing data, missing sample data. Okay, let's say for example, there is a one sample, but I'm not able to test just because the sample data is missing and I cannot apply the procedure because I don't have the data. In that case, that is a misstatement. Instead, where I'm not able to apply the procedure because the sample does not fulfill the selection criteria. It was something different. Okay. So procedure cannot be applied versus procedure not applicable. Now, once you have tested your samples, what you need to do is you need to project the misstatement to the entire population unless it's anomaly, and that is not applicable to the TOC. In TOC, you do not, extrapolate or apply the population or misstatement to the entire population. Okay. Then you need to evaluate the results of the sample testing and understand whether have you gathered the sufficient and appropriate audit evidence or not. Clear? Okay. Good question. So the question is, in analytical procedures, if we have taken data, okay, now we have performed some data analytics and we have, obtained some misappropriation or deviation or, misstatement. Okay, now should we treat that misstatement as just like a sample? And should we extrapolate that misstatement? Answer is depending upon the procedure. Okay. Now, what kind of procedure you have performed will define whether you need to extrapolate or not. Generally, no. But again, that depends upon the procedure you have performed. Let's, for example, there was a sales. Okay. So you did month on month. You did month on month analysis for sales. Okay. Let me have a chart here. I can show you in a good way. Let's say this is sale of product A. This is product 2 and this is product 3. Okay. Now you were expecting that the sale will increase from month to month. Okay. Let's say for example, Jan, Feb, March, April. I'll take till April as of now. Let's say you were expecting that, okay, the sale will increase from month to month. 6, 7, 4, 8, 10, 11, 13, 6, 7, 8, 10. Okay. Now let's say this is a particular data. I'll close it. You did this particular month-on-month analysis of sales. That is here. Now in this month-on-month analysis, you identified a particular deviation. Now this is a particular deviation I'm talking about. This particular region where the sale is falling down. Okay. Now this deviation where the sale is falling down, this deviation now is based on some expectations that you have obtained. Let's say, for example, your expectation was that it should increase, but it is going down. Okay, it should increase, but it is going down as of now. So this is a deviation or misstatement. Now the question was, can we, apply this misstatement to the entire population? Now, when you perform a particular analysis, month-on-month analysis, you already take the entire population. Then only you can get the appropriate results. Let's say, for example, you have only taken 3 products. Can you apply this particular deviation to the rest of the products? If there are more products, answer is no. So that depends. Can you apply this particular, what you can say, deviation or difference? Basically, you are identifying selecting for investigation to the entire sales. Answer is no, because product 1 and product 2 is increasing, product 3 is decreasing. Can you apply this to all the months? Answer is no, because it may happen that subsequently it may go up. It depends upon, because we have taken only 4 months data as of now. So again, that depends upon the type of procedure, but in normal circumstances, no, the deviation or misstatement you have cannot be extrapolated to the entire population. Reason, because you have considered that particular entire population, and that at that particular point in time, a new concept comes into the picture that I was going to talk about, that is stratification. Okay. Now, what is stratification? Stratification is dividing the population into subpopulations, that within the subpopulation, everything represents that particular subpopulation. The entire sample represents the subpopulation. Okay, let's say, for example, I have a very big population. I cannot test this population on a standard basis. Okay, what I can do now with respect to this population is I can do stratification. If this contains a lot of things, overall it's a circle, but inside it contains a lot of different kind of shapes. Okay, then what I need to do is I need to first do the stratification of this particular population. Means I need to divide this population on the basis of different type of samples that are there. Let's say, for example, somewhere I may have a square type of samples. Okay, somewhere for some of the population I have let's say triangle shape of population. Again, that depends. And somewhere I may have a circle population. Some samples represents the circle itself. So whatever the case may be, whatever the stratification may be, okay, whatever the stratification may be, what I will do is now I will select sample from this particular square and whatever sample will come, I'll say, okay, I'll apply test procedures as per square. Means I will consider this square as a one population, and I will call that the strata. That is a word that we use, strata. This is the first strata. I'll take up this, I'll consider as a second population, I'll apply procedure as per the triangle. And then the rest plus this, I can consider as a third strata, and I can apply the testing procedures that I was supposed to apply to a circle. This is how I can do on a stratification basis. I hope I'm clear. So that's why a misstatement cannot be applied to the entire population when it does not represent the entire population. So if I find a misstatement in square, I can only extrapolate to the square because that's a particular strata from where it belongs. Okay. Then if when I have a higher risk of material misstatement, okay, I need to select higher samples in order to get more comfort. So the sample type directly represents directly connected with my risk of material misstatement. If I'm relying more on the substantive procedure, okay, other substantive procedure, if I'm relying more on other substantive procedure, then my sample size will be smaller, okay, from this particular testing because I have performed some other substantive procedure. The higher the level of assurance I need, the higher the sample size I need to take. And the lower the tolerable misstatement is, the larger the sample size needs to be. Now, what is tolerable misstatement? There are two concepts with respect to the misstatement itself. One is a tolerable misstatement. One is a tolerable rate of deviation. Okay. Now, what is a tolerable misstatement? It's nothing but a monetary limit that you will set as an auditor. It's nothing but a monetary limit, just like a materiality. Monetary limit, okay, that you will set as an auditor to obtain the level of assurance from that particular, misstatement. Like, for example, I had a misstatement over here. This one, say this one. I had a misstatement in this particular testing. Okay. Now I want to understand whether this misstatement is material, not material. Okay. How can I understand that particular thing? That whether this misstatement is material or not material. So to understand that particular thing, that whether a misstatement is material or not material, okay, what I need to do is I need to define a tolerable misstatement level. That till this level, fine for me, but above this level, a misstatement is not tolerable. I will not tolerate that misstatement and I will classify. Let's say, for example, my tolerable misstatement limit is rupees 2000. If any misstatement in total I have identified till 2000, fine for me. I'll tolerate that misstatement, I'll accept this and move forward. I'll not report it basically as into the category of misstatements. But if something I have received which is more than 2000, that is not tolerable. Means the population contains the misstatement. That is something, a tolerable misstatement, and that is used for TOD. When I do a test of details, I use tolerable misstatement as a limit. So some of the sample selection criteria also contains a tolerable misstatement limit. So there are certain sample formulas that they help you to derive some samples, and they have this particular tolerable misstatement within that particular population itself. So that was with respect to your sample selection or your tolerable misstatement. Now comes to the second area is tolerable rate of deviation. Okay. Now, what is the tolerable rate of deviation? This particular concept of tolerable rate of deviation is used in test of controls. So, when I talk about tolerable rate of deviation, means a prescribed deviation, a rate of deviation. Here I am using the rate, so it is in the percentage. So, a percentage describe that, okay, when I test particular control, my deviation should not exceed this much percentage. Let's say I set a deviation rate 2%. So whenever I'm testing my control, my deviation should not exceed 2%. So that is the tolerable rate of deviation. Clear? Any doubts? Okay. So this is the particular concept of audit sampling. There are these are the concepts of audit sampling where we discussed. Okay. And if no further doubts, then what I suggest is let's take some questions on this particular topic so that we can have a good clarity what we about the topic. Okay, let me bring the question. Give me a minute. While designing the audit procedure, the audit team decided to perform substantive procedures over the direct expenses, which were assessed as a material with respect to the financial statement as a whole. Moreover, the number of items transactions in the direct expenses were huge and were of non-homogeneous nature, means they were not similar. As a result, the audit team decided to select some samples from each identified strata, disaggregated to the lowest level based on their characteristics. Based on the testing performed on the samples selected from each strata, the following results were obtained. Now, this is based on the testing. Balance as per the book of that particular expense, total samples selected, number of samples, exception, amount in samples, reason for exception, one invoice was booked incorrectly. Loading charges, 4 lakh rupees, balance sample total 80,000 selected, 15 samples, no exception. Shipping, again, no exception. Packaging expense, 8 lakh rupees, 240 selected, 5 samples, exception amount 3,000, no documents were available for the same sample. Storing expense, 12 lakh, 1 lakh 20,000, 10 samples selected, deviation was 8,000. Warehouse charges, were booked as a storing expense, wrong classification. Okay, so warehouse charges were booked as a storing expense. Okay, wrong classification. Now, based on the above results, the audit team decided to project the total misstatement on the entire balance considering the testing. As per the calculation performed, the entire misstatement was, the projected misstatement was this much. Means they took the 36,000 for 8,10,000 and projected on the total population. Okay, so they simply did this. Okay, if I have a misstatement of 36,000 on my 8,10,000, then how much I will be having for 38,000 or 38 lakh as the entire population. So they projected the misstatement basically 36,000 into 38 lakh divided by 8,10,000. Cross multiplication you can say, or projection. No other misstatement were identified which could surpass individually or in combination with others. The performance materiality of was rupees 10 lakh. Okay. After considering the impact of projected misstatement and materiality, the audit team decided to modify the audit opinion with respect to the direct expense. You as an engagement quality control reviewer, while reviewing the work paper, identified this. What would you guide the to the engagement team with respect to the projection of the misstatement? Now you tell me what should be the appropriate projection of misstatement. Let's not go to the options first. Let's understand the concept. What you can take as a projected misstatement. What do you think is a projected misstatement in the current case? Come on, guys. What do you think is the correct way of projecting a misstatement in this case? Let's go expense by expense. Freight expense. How do you project this particular misstatement? How will you project this particular misstatement? Correct, Manani? Correct, absolutely correct. So I am required to extrapolate the misstatement strata wise instead of the whole expense level. Means when I extrapolate the misstatement, I need to consider this 25,000 in front of this 5 lakhs, not for the whole. Reason because a misstatement of freight expense cannot be extrapolated in front of loading charges, shipping charges, or other charges. Okay. And accordingly, I need to decide whether, what should be the correct misstatement. Now let's see the options over here. The projected misstatement calculated is appropriate. Moreover, based on the performance materiality, the projected misstatement, the auditor should modify his opinion. When a class of transaction or account balance has been divided into strata, the misstatement is required to be projected for each stratum separately. Hence, the audit team approach is incorrect with respect to the calculation of projected misstatement. The audit team should recalculate the projected misstatement and they should consider its impact on overall audit opinion based on the materiality. The audit team shall have considered the exception of 8,000 twice while calculating the projected misstatement, as the error is regarding wrong classification, and same will have effect two class of transaction or balances Hence, the team should consider considering revising the projected misstatement, and then they should consider the impact on overall audit opinion. The fourth one is audit team have appropriately calculated the projected misstatement. However, before modifying the audit opinion, the audit team should obtain written representation with respect to the completeness and accuracy of the direct expense balance, which could serve as a sufficient and appropriate audit evidence. So, yeah, the correct option here will be option B, because misstatement calculation is not correct. I hope I'm clear. Any doubt? Okay. If no further doubts, then just a minute. Yeah. If no further doubts, then I suggest we move to the next standard. So this gave you clarification and understanding how you need to project a misstatement and how you need to consider it, whether it's a material or not. Okay. So I'll move to the next standard. Very important one. Very important. It's SA 540. Okay. SA 540, basically this essay talks about your accounting estimates, including fair value estimates and related disclosures. Very important one, because a lot of estimates are there when we talk about an audit of a financial statement, because at the end, you cannot have a financial statement without estimates. There might be some estimates. Okay. So that's why this standards, it's because of its nature, becomes very important. Okay. Now, when I talk about estimates, okay. So what this standard does is, what is the basically scope of this standard in that case? Now, if you see the scope of this standard, the scope of this standard is auditor's responsibility regarding the accounting estimates, including fair value estimates and related disclosure. Means it specifically helps the auditor, okay, with respect to the application of SA 315 and SA 330. It tells the auditor how to apply SA 315 and SA 330 in relation to the accounting estimates. So you can say specific application of SA 315 and 330 with respect to accounting estimates. Okay, so we will be seeing how to apply SA 315 and 330 for an accounting estimate. Okay. Now, it also talks about, and management bias with respect to accounting estimates, evaluating the management bias. Now, remember we had an essay discussion in essay 240 regarding management bias. So same way it talks about management bias over here also. Let us see here. The scope is that the auditor's responsibility regarding accounting estimate, including fair value estimate, accounting estimate, and related disclosures in an audit of financial statement. It usually expands on how SA 315 and 330 and other relevant essays are to be applied in relation to accounting estimates. Now, again, the objective of the auditor will be to obtain insufficient and appropriate evidence whether the accounting estimates in financial statement are reasonable, related disclosures in the financial statement are adequate with respect to accounting estimates. Okay. Now, these are the certain objectives of the particular this standard and the objective of the auditor over here. Now, before we go into deep of the accounting estimate, we need to understand few things. Number one, what is an accounting estimate? What do we mean by accounting estimate? Now, when I talk about accounting estimate is nothing but appropriate. You can say approximation of a particular amount. Let's say, for example, I want to estimate something. I'll give an amount. Okay, this is an estimate based on my judgment or something. So, approximation of a monetary amount in absence of a precise means of measurement means I do not have a precise means. That's why I am doing the estimate. Okay, so that's an estimate. Now, what happens is in estimate there could be a bias. Bias means you are tending or you are going towards a particular side. Now, what will happen is when a management makes an estimate, they may have a biasness, lack of neutrality in an estimate, that they will show good and rosy picture, or they may show the estimate like they want. It will not be neutral based on the facts or based on the circumstances or the methodology, but it may be based on the biasness. That could be the case. Okay, so there can be a management biasness in that particular estimate. So what management does is management will first, they will have their point of estimate. Okay, so I'll show you step by step process with respect to the estimate. Now let us talk about the step by step process for estimates. Now what happens is step number 1, management will identify areas or transactions that require accounting estimates. So they will go and identify the areas which requires accounting estimate. Okay. Then what management will does it that management will understand the requirement of financial reporting framework. Okay, what is the requirement of financial reporting framework with respect to accounting estimate? So what are the disclosure requirements for the accounting estimate? Then management will go and management will make the estimate, making the estimate. Okay, management will go and management will make the estimate. Okay, here. And while making the estimate, management will refer to the data that they have collected for the estimate. They will adopt some method to make the estimate. They will take some assumptions for the estimate. They might require the expert included for the estimate. Okay, and on the basis of that, they will prepare a management points of estimate. Management's point of estimate. Okay, management points estimate. So management will make that particular estimate. Basically, management points estimate means the amount that they will derive. That is the step that they follow. Now comes to the step that what we are required to do. So now I will note down the steps that we are required to do to understand this particular management estimate and to audit this particular management estimate. Okay. So basically, let's say for example, management has made this particular estimate by following these procedures. Now what we will do is we will understand, okay, what estimates and how they estimate they have made. So let's say for example, the first step, management will identify the areas for which they require accounting estimate. Now I will apply SA 315. Remember, this standard is nothing but the application of SA 315 and 330. So I will apply SA 315. Okay, with respect to identification of the risk of material misstatement. And what I will do is I will first understand, okay, that how management, for this I will understand how management identifies those transactions that require accounting estimate. Okay. Then I will understand what is the requirement of FRF, financial reporting framework, with respect to estimate. Okay. Now management might say, okay, we have a control for this. Management might say they have a control for this particular area. So I will understand controls behind estimation process. Okay, I will understand the control behind the estimation process. And when I'll say I'll understand the control, what I'll do is I will check two things for those controls. I will check two things for those controls. One will be your design efficiency, whether controls are designed appropriately. Second, whether they are operating effectively. Okay, so I'll see whether the control over the estimations are designed appropriately and operative effectively. Okay, now design is something I'll check while SA 315. I'll understand the design of the control and I'll decide whether that design is appropriate or not. So I'll apply SA 315 over here with respect to understanding the design. Okay, and based on that, I'll identify whether there's a degree of uncertainty, whether there's a significant risk. I'll identify the risk of material misstatement. So I'll check for the risk of material misstatement or significant risk. As of now, I'll remove this one and add later on. Okay. Now, I'll bring that to this side. Operating effectively and design efficiently, appropriately. Okay. Now, as I told you, I'll check the design while I'll discuss about the SA 315. As per SA 315, I'll check the design. But when I talk about operating effectively, what I'll do is I will also check operating effectiveness by performing TOC. So when I talk about operating effectively, I will perform TOC. Okay. And when I talk about TOC, I'm talking about test of controls, test of operating effectiveness. So at that particular point in time, when I talk about TOC or you can say test, I'm talking about SA 330. Response to the assessed risk, whatever risk I have decided now, I have a response. Also, whatever method that they have used while making the estimate, the data, the method, the assumptions, and the expert, if they have hired, all 4 items, I will validate, okay, whether they are appropriate or not. Okay, let's say, for example, for data, I'll check whether the data is reliable. Okay, for method, I'll check whether the method is appropriate. Okay, for assumptions, I'll check whether the assumptions are appropriate plus consistent. Also here also I'll check the consistency. Then for the expert, again, I will check, all these things, whatever expert he has appointed. But with respect to expert, what I'll do is I'll check the reasonable, skill, care, competency of that expert. So skill, competency, okay, other factors for that particular expert. So all these things I'll check, and when I will check with respect to my SA 330. What I will do is I'll perform the test, and I'll check with SA 330. Then when I talk about management will come with a point estimate, what I will do is I will compare that particular management points estimate with auditor's point estimate. Means what estimate that should have been. I will make another estimate by using the same method, same assumptions, same data, and I'll see okay whether the estimate which has been made by management is appropriate or not. I may come also with a range, auditor's range. If a point estimate is not possible for me, I'll go for a range. But I'll evaluate the management estimate. Also, I will evaluate the management estimate with respect to previous year estimate. Okay, what was the estimate in the previous year and what the actual outcome came of that estimate. So, actual outcome of previous year estimate. Okay. Then I may consider whether any other possible outcome for this estimate or these estimates have been considered. And if yes, okay, then why those were rejected? For example, let's say there was a litigation going on. I decided, okay, in this litigation, it will be in my favor. So I will first ask, any other possible outcome for this estimate was possible? Yes, the another outcome was, it may come into my, it may not come into my favor. It will be unfavorable, the litigation's outcome. If that was the outcome, that was possible outcome, then why you rejected? I rejected, management will say I rejected because all the facts and condition of the litigation points that I am correct. It will come into my favor based on the preceding cases and everything. Then I'll evaluate, okay, why management did not consider this particular outcome and why management considered this outcome. Now, very important part is, what if there is a difference between auditor points estimate and management's point estimate or auditor's range? If there is a difference between both of them, okay, if there's a difference between management's estimate and auditor's estimate, then what you need to do is evaluate suitability of method and assumptions used by management. Method or assumptions used by management. If there's a difference, then consider whether the management, whatever assumptions or method they have used, are correct or not. If they are appropriate, okay. If you find, okay, now they are appropriate, then what you need to do is you need to develop another estimate. Develop another point estimate and compare with that particularly. If you think they are not appropriate, then calculate the deviation and its impact as a misstatement. Okay. So you need to consider the suitability of the management methods and assumptions used by the management. If appropriate, then develop another estimate. If not appropriate, then calculate the deviation and its impact on the audit opinion. Okay. So this is how I apply 315, 330 to the to the estimates. Clear? Any doubt till now? Any doubt? So there is one question with respect to tolerable misstatement. The question is, in deciding tolerable rate of deviation or tolerable misstatement, can the auditor consider management suggestion? Usually you shouldn't be. See, when you are deciding the tolerable rate of deviation or tolerable misstatement, it is something you decide on the basis of materiality, the population, and there are other factors which are involved. Okay. And it should not be based on the suggestion by the manager. Then there is another question with respect to this particular standard. Fair value shall always be on the estimated basis. See, if you have seen fair value estimates, there are required in various standards. So again, we need to see fair value measurements and where it is required and where we are going for the fair value estimates. So again, it depends upon case to case basis. Usually, fair value estimates are used for derivative financial instruments, which are not publicly traded, or when you are developing model, specialized entity developed models, which are used again somewhere for some complex accounting. Then those fair value estimates are used. Any doubt? Any further doubt, guys? So this was the whole standard that we discussed basically. So I'll take you quickly through the notes. So when I talk about estimate, what auditor is required to do is understand the requirement of applicable financial reporting framework with respect to accounting estimates and disclosure, how management identifies transactions, event, and conditions that may give rise to the need of accounting estimates. Then you need to understand how management makes the accounting estimate, including method, applicable control present for accounting estimates. Okay, if management use expert and its assessment, then you need to understand that whatever assumptions made by the management in accounting estimate, if any changes in the method of making accounting estimate, then you need to understand the reason for such changes and how management has assessed the effect of estimation uncertainty. Okay, you need to assess the effect of estimation uncertainty, and then you need to evaluate the previous year estimate and their outcome. Also, you need to evaluate the current year estimate and their outcome if present till the date of audit. Now, this was understanding the estimate. That was application of SA 315. Now I'll talk about SA 330. Then you need to understand whether the management has appropriately applied applicable financial reporting framework for the disclosure for accounting estimate or for calculation basically. Whether the management has appropriately and consistently applied method for accounting estimates. Check accounting estimate by validating whether the evidence available till audit report date is appropriate. Now then you need to check the following, that how management makes, sorry, just give me a minute. I think there is some technical glitch. Okay. So we were where we were with respect to, we need to check the following: how management makes the accounting estimate, including the method used in the accounting estimate, operating effectiveness of the applicable controls which are there in the accounting estimates, assumption made in accounting estimates. Okay. Then they are required to develop, auditor is required to develop point estimate or a range to evaluate the management points estimate. For that, we need to compare the assumptions and method used by the auditor with management. And if different, then we need to understand the reason and evaluate whether auditor's point estimate or range is sufficient to evaluate the difference. If auditor is using range, then narrow down the range until all the outcomes within the range are considered reasonable. Okay. Now, then with respect to the estimation uncertainty. Now, what is estimation uncertainty? Estimation uncertainty means how much portion of the uncertainty is there with respect to that estimates. Okay. So that is an estimation uncertainty. Generally, when I talk about estimation uncertainty, it's the susceptibility of the accounting estimate and its related disclosure that lack of precision, that to an inherent lack of precision means how much there is an uncertainty with respect to that estimate that I cannot even bring the precision by using the method or by using some data even. You can say the degree of the uncertainty with respect to that estimate is estimation uncertainty. Let's say this particular estimate is highly uncertain. I cannot come to a point of precision. That is an estimation uncertainty. Okay. Now, when I talk about estimation uncertainty, I need to understand how management has considered alternative assumptions. Sorry guys, I think there was some network issue and technical glitch. Okay, I'll continue. So we were at obtaining sufficient and appropriate audit evidence regarding management decision to recognize or not to recognize, the other accounting estimates range that were developed. Okay. Now, once we have the sufficient and appropriate audit evidence, then we need to see the selected measurement biases for the accounting estimate. Means, what is the biasness? That okay, there are three outcomes. Why management is going toward a particular one outcome, not rest towards the rest of two outcomes. So we need to understand the biasness. Then comes the disclosure part. Okay, I need, as an auditor shall obtain sufficient and appropriate audit evidence related to the presentation and disclosure of the accounting estimate as per financial reporting framework. Now, for accounting estimate that give rise to the significant risk, adequacy of their disclosure of estimation uncertainty is must. Means you need to understand what is the disclosure requirement which for the accounting estimate that gives rise to the significant risk. You need to obtain written representation with respect to the significant assumptions used in making accounting estimate and whether they are reasonable or not. Now, again, you need to consider the indicators of possible management bias. Okay. Now, management biasness do not themselves constitute this statement. You need to evaluate the management biasness. Okay. It is not, let's say, for example, there were three outcomes of an estimate. Let's say one of the outcome was rupees 5,000, another was rupees 10,000, and another was rupees 25,000. Okay, now that was the outcome of an expense. So management was biased that okay, I want to show lower expense. So management selected this one. Now that doesn't mean this is incorrect. You need to evaluate and you need to check why 5,000 is correct or why 5,000 is incorrect compared to 10,000 and 25,000. Also, you need to ask management why they rejected these two. Why rejected these? So it is not necessary that management biasness is misstatement. You need to evaluate, you need to understand, and then you need to finalize whether this biasness is a misstatement or not. Now, there is a question that what is the effect of estimation assessment uncertainty, estimation uncertainty. So, see, the more the uncertainty, the more it is difficult to come to a precise estimate. Okay. Now, more the uncertainty, more the difficulty into the finalizing the estimate, and more are the chances that your estimate is wrong. So there is a higher the uncertainty, higher the significant risk, or higher the risk that the estimate is wrong or estimate is incorrect. Okay, or the methodology, assumptions, data used in the estimate is not appropriate. And higher the risk, it may lead to a significant risk also. So the effect of estimation uncertainty is directly linked with the risk assessment of that particular estimates. Any further doubts? With respect to the estimates? Any further doubts? Okay. If no further doubts, then what I suggest is let's take a quick 10-minute break. And after the break, we'll take the questions for this particular topic. Okay. And some MCQs.
Hello everyone, welcome back. Okay, let's take some questions and some queries that are there for this particular topic. So the first query is, if the auditor estimate and management's estimate do not match and not at a tolerable rate, then what auditor should do? If the auditor's estimate and management estimate do not match, then at that particular point in time, what you need to understand is that how much difference or deviation we are seeing here. What is the rate of deviation between both of them? Or you can say like whether it's, the deviation is more or less. And accordingly, based on the materiality, you need to understand whether this deviation, okay, is misstatement or not. So it totally depends upon the type of the deviation, the amount of the deviation, and like what is the risk we are looking here for that particular deviation. Second question is that like the accounting estimation uncertainty, is it something related to the probability? See, estimation uncertainty is more onto the difficulty with respect to the estimation, that okay, how much uncertainty it is and how much accurate we are able to make the estimate. That is something estimation uncertainty talks about. Okay, then let me take some questions on this particular topic, very important. During the financial year 2021, the management of the Estimates Books Limited decided to book a provision for ongoing indirect transfer litigation for the taxation liability raised by the Income Tax Department. While deciding the appropriate amount for the litigation liability estimates, litigation liability estimate, management was of the view that there is a high degree of uncertainty of the outcome, and hence no fair estimate of the liability can be determined. However, after consultation with in-house legal team, management decided to book an optimistic estimate. Okay, so management decided, let's book an optimistic estimate. Mr. K, audit senior of the audit team of the Estimates Books Limited, decided to gather evidence for state accounting estimate. Considering the same as a material and significant by reviewing whether the events occurring up to the dates of auditor report provide audit evidence with respect to the estimate, how management made the accounting estimate and the data on which it's based on, whether the method of the measurement used by the measurement is appropriate in the circumstance, whether the assumptions used by the management are reasonable in the light of measurement objectives. However, Mr. K was of the view that the development of the auditor's point estimate will be duplication of the work which is already performed by the management, and hence he should use the same point estimate and should only perform the above mentioned review. Moreover, he was of the view that there are less chances of the management biasness, and hence no additional audit procedures are required to be performed to gather further audit evidence. You, as an engagement audit team, manager of audit team, guide your senior by selecting the appropriate response from below. So the response are: in responding to the assessed risk of material misstatement, the auditor shall develop a point estimate or a range to evaluate management points estimate, taking account of the nature of the accounting estimate, and shall review the judgments and decision made by the management in making of accounting estimate to identify whether there are indicators of possible management biasness. In responding to the assessed risk of material misstatement, the auditor shall not develop a point estimate or range to evaluate management's points estimate. However, the auditor shall review the judgment and decision made by the management in making of accounting estimate to identify whether there are indicators of possible management bias. In responding to the assessed risk of material misstatement, the auditor shall develop a point estimate or a range to evaluate management points estimate. However, the auditor shall never review the judgment and decision made by the management in making accounting estimates to identify whether there are indicators of possible management bias. In responding to the assessed risk of material misstatement, the auditor shall neither develop a point estimate or a range to evaluate management points estimate, taking account the nature of accounting estimate, nor shall review the judgment and decision made by the management. So, what do you think is the correct answer over here? Out of these four options, what do you think is the correct answer? What auditor should do? Good, Manini. Correct. Come on, guys. What auditor should do here? So the question is that Mr. K was of the view that the development of auditor's point estimate will be duplication of work. He is saying that will be duplication of work, and he should not perform it. What should be the correct option over here? Okay, good, Sumit. Come on, guys, I'm waiting for your answer. What should be the correct option over here? Come on, guys. So whether the auditor should develop or they should not develop an independent point estimate. Now we are also required to review this particular item that that there was a high degree of uncertainty, okay, estimation uncertainty of the outcome, and that was a high degree of uncertainty. And later on, management consulted with the in-house legal team, and management decided to book an optimistic estimate. So these are the also points that are required to be considered while you select an appropriate option. So what should be the option? Correct option. Okay, let's see the answers and evaluate each one by one. First one. First of all, let's go to the question and understand that there was a high degree of uncertainty. Management decided to book an optimistic estimate. Okay, so you have a high estimate uncertainty. High estimate uncertainty. Okay, then you have a management biasness because management decided to book an optimistic estimate. Okay, then the auditor was of the view that they should not perform. They should not perform audit. They should not develop independent auditor's estimate. Okay, so now, if there is a high estimation uncertainty, if there is a management bias, then not even then, but it is necessary for the auditor to develop an independent auditor's point estimate or point range. So, not developing the independent point estimate, okay, is not correct. So auditor shall not develop. So auditor shall not develop a point estimate is not correct. Here also auditor, it's there that auditor shall develop a point estimate, but auditor shall never review the judgment and decision made by the management. To identify whether there is a indicator of possible management biasness. That is also not correct. Third one is auditor shall neither develop nor review any judgment. That is also incorrect. So in all the cases, in second, third, and fourth, it's incorrect because auditor is required to review, and hence accordingly the answer will be A, where it's written that auditor is required to review all these things. Reason, you have a management biasness, so you should look for management biasness. Number two, you should develop a point estimate. Reason, because there is a high estimation uncertainty. So one should be the correct answer. Any doubt? Any doubt? Okay. If no further doubts, let's take one more question onto this topic. Messrs. H&K Company was appointed as an auditor of GSB Limited, a company operating its business in telecom sector. As per the spectrum allocation agreement with government, GSB Limited is required to pay a certain percentage of its annual license revenue as in license. This is known as an AGR, basically. Okay, AGR fees that they pay. GSB Limited paid the license fee on its core business for last 2 years. At the end of third year, the communication was received from the government that it needs to pay agreed percentage on its total revenue. Okay. So GSB was paying license fee on its core business. See, so it's paying on core business. At the end of third year, communication received that they are required to pay on the total revenue, not only on the core business. Okay. Now, just to give an example like this one to make you understand. Let's say in telecom company, there are multiple businesses. One is sale of talk time, or plans or recharge or whatever you call it. Sale of plans, which is prepaid and postpaid. There was another sale of mobile equipment with plans. Okay, means they were selling iPhone, they were selling other mobiles with the inbuilt plan in it. Okay, now earlier the annual license fees was paid on the core business, that was sale of plan only, but not on the total revenue. That should be total of these. Then they received a notice from the government that asked them, okay, pay on the total revenue, not only on the core business. Matter was disputed and went to the court of law. On a prudent basis, GSB Limited made a provision on estimated business in its books of account of agreed percentage on non-core business systems. The amount of provision of such huge amount that the GSB's profit and loss account for that quarter reflected loss due to that provision. However, how you as an auditor can evaluate this accounting estimate, which involves significant risk, and what if the management has not addressed the effects of estimation uncertainty on the provision made? So how will you evaluate this estimate? Let's talk about the first, point, that how will you evaluate this accounting estimate? How will you evaluate? What you will do to evaluate this accounting estimate? Come on, guys. How will you evaluate the accounting estimate. Simple. Pretty simple. We have already discussed this particular point. Evaluation of accounting estimate. Absolutely correct, man. You absolutely correct. Come on, guys. How will you evaluate the accounting estimate? This particular accounting estimate. Okay. So remember we discussed this particular thing when we were discussing about the application of SA 315 and 315. Oh, 330 and 315. Okay. So when we talk about evaluation of accounting estimate, how management identifies those transaction, requirement of FRS, controls, design and operating effectiveness, auditor's point estimate, we need to consider the reliability of the data, appropriateness and consistency of the data, appropriateness and consistency of the assumptions, skill competence of the expert who has made the estimate. We need to develop our own estimate, point estimate. We need to compare with the previous year actual outcome and the estimate. If we have the data, then we can compare the current year outcome also. So all these things. Let's go to answer. In the given case, HK and Company was appointed an auditor of GSB Limited operating in telecom sector. GSB paid a license fee on core business revenue, whereas government required to pay on non-core business receipt as well. Consequently, the amount of provision was such huge amount that GSB's profit and loss account reflected a loss due to that provision. As an auditor, evaluation would done as under. For accounting estimate, there lies a significant risk. In addition to other substantive procedures performed to meet the requirement of SA 330, the auditor shall evaluate the following. How management has considered the alternate assumptions for outcome, why it has rejected them, how management has otherwise addressed the estimation uncertainty in making the accounting estimate, whether there is a significant assumption used by management are reasonable, where the relevant reasonableness of the significant assumption used by management or appropriate application of the applicable financial reporting framework, management intends to carry out the specific course of action and its ability to do so. If in the light of auditor's judgment, okay, management not adequately address the effect of estimation uncertainty on the accounting estimate that gives rise to the significant risk, the auditor shall, if considered necessary, develop a range to which evaluate the reasonableness of the accounting estimate. So that's how you will evaluate the accounting estimate. And the second question was, what if management has not addressed the effects of estimation uncertainty on provision made? So for that, the answer is here. This one, the fourth point. If in the auditor's judgment, management has not adequately addressed the effect of estimation uncertainty, the auditor shall develop a range to, to evaluate the reasonableness of accounting estimates. Clear? Any doubt? Any doubt with respect to this question or any of the point of this particular essay? Okay. If no further doubts, then I think we can move to the next standard for today. Okay. So the next standard that I want to discuss, again, important standard that talks about related party. SA 550 related parties. So very important standard again. Okay, very critical one, because in most of the cases, in most of the entities as of now, you will see related party transactions. So related party transactions are certain, which are present everywhere. Okay, so let's understand this particular standard, how it works. Okay. The scope of this particular standard deals with the auditor's responsibility regarding the related party relationship and transaction when performing an audit. Again, it specifically extends the application of 315, 330, and 240 when we identify a risk of material misstatement associated with related party transaction. Means this standard guides with respect to application of SA 240 plus 315 plus 330, okay, for related party transactions. Or I will use the term RPT. In exam, you need to write the full words, not the abbreviations. Please do not use such abbreviations or short forms to answer the question. Yeah. Okay. Now, many related party transactions are in normal course of business. It's not necessary that we have a related party transaction means there is a misstatement. So it is not necessary that related party transactions are alternate for the misstatement. No, related party transaction can be normal course of business. Okay. Now, in that case, there can be normal risk of misstatement with respect to the related party transaction and financial statement, because they are at the normal course of business, as we have other transactions with the other unrelated parties. So, in that case, if any related party transaction is there, basically, okay, and the normal course of business, that doesn't mean there is a need for higher risk. So we need to understand which kind of related party transactions constitute higher risk or even fraud risk. Okay. Number two, what are the scenarios where we can say, okay, this is, the auditor can consider higher risk with respect to the related party transactions. And if there is a higher risk identified, then what auditor should? So first of all, understanding the entity with respect to the related party transaction, that is nothing but the application of SA 315. So applying SA 315. Then comes responding to the risk of material misstatement over relationship and from the related party relationship and transaction. So responding means that you design some audit procedures, you go and you check whether there is a risk of material misstatement and whether there actually has a material misstatement or not. So you apply SA 330 to that. Then while testing, if you come across any related party transaction which is not in the normal course of business, then you check the application of SA 240, that is fraud risk. Okay. And at the last, once you are near to the closure of your testing or during your testing period, you apply SA 580, that is return representation. Okay. Now let's go through each in detail. So as I said, the scope of this particular standard is auditors, the auditor's responsibility regarding a related party relationship and transaction. And the objective of the auditor is to understand the related party relationship and transaction, number one. Number two, recognize the factors, fraud risk factors, if any, arising from the related party transactions. Means understand whether, or you can say, applying SA 240. And here objective was applying SA 315. And third, to conclude whether the financial statement affected by those related party relationship and transaction achieve a true presentation are not misleading, and where the ARF applicable financial reporting framework established related party requirements, obtain sufficient and appropriate audit evidence whether related party relationship and transactions have been appropriately identified, accounted for, and disclosed in the financial statement. So all these three talk about 330. Okay. I'll come on to that particular question in a while for answering price. Okay. Now, that's particular understanding the entity and its environment. Let's go through and understand what are the requirements of the auditor or what auditor is required to do. So when we talk about understanding the entity and its environment, the auditor or the engagement team is required, okay, to make inquiries of the management regarding identifying, the entities related parties, including changes from the prior period. So first of all, we need to make inquiries to understand which related parties are there, identifying the related parties and change in them from previous year. So some new related party might have been added because of some mergers and acquisition or incorporation. Some related parties might have been, now gone out of the related party definition because we lost the control, we divested that particular entity was closed, liquidated, whatever the. Then, nature of relationship between entity and these related parties, associate, joint ventures, subsidiary, fully owned subsidiary. What is this particular, relationship? Transaction with these related parties and the type and purpose of the transaction, whether this is a cross charge, interest transaction between intercompany, or sale purchase transaction, what type of transaction it is. Obtain understanding of the control placed over, identification and disclosure of the related party transactions and relationship, authorizing and approving significant transactions and arrangement with related parties. Now, just to understand, there are some requirements of related party, okay, in company sector. Now, when we talk about company sector and the requirement of related party, can anyone tell me which section it is of the company sector which talks about the related party transaction? Which section in the company sector talks about the related party transaction? Come on, guys, you might have already seen. Which section of company sector talks about related party transaction? Okay, so section 188 talks about the related party transactions. Now, when I talk about section 188, okay, section 188 talks about that, okay, subject to the, except with the consent of the board of directors, given by a resolution at a board meeting. Okay, no company shall enter into a following kind of transactions. So there is a condition that you need to take a consent from board of directors. Okay. At certain places, there are other conditions also mentioned that resolution passing the resolution under shall be between the company and placed at AGM. A lot of conditions are there. A lot of conditions. Okay, but the point is that all those conditions, whatever they are in the section, this signifies, okay, the authorize and approve of the significant related party transactions with or within or outside the scope of business. Means they kind of create an requirement of the approval or requirement of a control that each and every related party transaction should be approved either through a block approval by the board of directors or one on one. So the financial reporting framework, applicable financial reporting framework and laws and regulations may require some additional requirements with respect to whatever area it is. Let's say in case this is a related party, so you need to consider what are the requirements of laws and regulations also with respect to the related party transactions. Okay. Then you need to understand whether there are controls behind that particular requirement. Let's say, for example, company sex required under section 180. Whether there is a process within the company which helps the company to comply with section 188. So that is the understanding the entity. Then you need to inspect records, documents, arrangement that may be indicated the existence of the related party relationship or transaction that the management basically has previously not identified. Very important. See, management has not important that particular related party transaction, related party relationship. You can identify by inspecting the records, documents, arrangements that are there. So that will help you to understand, is there any related party transaction which was not disclosed earlier, but it exists. For example, there is a new company which was incorporated during the period. Okay. Now you may not come to know till the time management do not disclose. Let's say if it is by guarantee, not by limited by shares, without share capital. A company incorporated by the company, the current company for which you are auditing, which does not have a share capital. In that case, it will be very difficult to identify from the money flow or from bank accounts. You can only identify if any resolution, any minutes, or if any somewhere it is documented that particular detail. And accordingly, while it's inspecting the records, document arrangement, you need to take care whether any related party relationship or transaction is there which management has not disclosed or not previously identified. In case when the significant transaction outside the entity's normal course of business is identified, then auditor shall inquire about the nature of transaction and potential involvement of related party. Let's say there's a normal course of transaction. Now you have come across a transaction which is outside the normal course of business. For example, ABC Limited involved in selling of vacuum cleaners okay, plus hair dryers, let's say for whatever equipment it is. Okay. Now, while selling the vacuum cleaners, one of the transactions of ABC Limited with OPQ Limited was for sale of fixed asset, or you can say machinery. Okay. Now, this particular transaction is not in normal course of business. Means the business means that ABC Limited do not sell fixed asset on a daily basis, or ABC Limited's business is not to sell fixed asset. So that's not in normal course of business. Now, once you identify such kind of transaction, what you will do is first you will check the nature of the transaction. Okay. First, you need to understand what is the nature of the transaction. Second, you need to understand whether this is related party. So you need to understand like this way, whether this is a related party or whether what is the nature of this particular transaction. Okay. This will help you to understand whether any, outside normal course of business transaction has not been reported. Usually, companies do not sell to third parties the fixed asset. These transactions are done within the group companies or inter companies, sort of like that. And hence, it's very, very important to understand, such kind of transaction. Share the related party information with other engagement team members, and after the above procedures, assess whether there is a risk of material misstatement present or fraud risk present for related party transaction. So after doing all this, you need to understand whether there is any risk of material misstatement or fraud risk. So this is how first you understand the entity and you assess the risk of material misstatement or fraud risk. Okay. Then, any doubt till now? Any doubt? See, there are certain documents that management cannot deny. For example, minutes of meeting, or for example, you can say, resolutions passed. Okay. So these documents are certain documents that are, required to be shared with the auditor. And usually, let's say you will come to know reason because, if there is, resolution passed, but if resolution number is missing, so some resolution numbers in between are missing. So you have a resolution number 1, 2, 3, 4, 5, then 6, 7 is missing. Then you have 8, 9, 10. You may ask from the team if they have entered into any transaction, something like that. Some documents that, you look and you come across some documents, some references or something like that. However, if still you think that, your management is not providing access, then there are other alternate procedures that you can perform. But we cannot just, can say, okay, to management that, okay, let's say, for example, I went to management, I said, okay, give me all the minutes of the meetings and all the resolutions. So they gave me minutes of 4 meetings. Now, I performed the procedures, I went through everything, and I'm saying, no, there is something missing. There is something, I think there is one more meeting which is missing, which management has not given minutes of it. I go to the management and I ask them, okay, share me the minutes. There is some meeting missing in between. So in that case, I need to first provide the details of that meeting. I cannot directly just say on the basis of my hunch, okay, there are some meeting missing, you are hiding something. So I need to perform some alternate procedures. I cannot just, go and say, okay, these there should be some more meetings. These are not only 4 meetings. There will be more you are not giving me. Unless and until there should be something, contrary available, which points us towards that direction. We cannot, just say that, okay, that this is, management is hiding something. So till the time you don't have anything contrary to that, it's usually, we have to accept that particular fact that, okay, whatever we have been given is a complete. Yes, having said that, we need to perform audit procedures to ensure completeness. But even after performing audit procedures, we have ensured completeness, and we did not come across any particular thing and any particular item which points us that this particular data or information is incomplete. Then we cannot just on the basis of a hunch can say it's incomplete. Any further doubts? Any further doubts? Okay. If no further doubts, then let's proceed to the next point, that is responding to the risk of material misstatement. Now, when we applied SA 315, we either we might have came to a conclusion whether there is a risk of material misstatement, whether there is a risk of material misstatement and fraud risk. Fraud risk plus significant risk. Okay. Or there is no risk. High risk, low risk, whatever. So high, medium, low. So we might have came to a conclusion this particular way. Okay. Now, whatever risk we have identified, now we need to respond to that risk. Let's say, for example, we say there is a high risk of material misstatement, or we say there is a significant risk plus fraud risk. Then accordingly, we need to plan the audit and perform the audit procedures. Let us see how in that case we can apply SA 330. If the auditors identifies undisclosed related party arrangement and transactions, or if the auditor identifies any information which points to the undisclosed related party arrangement and transaction, then communicate to the whole engagement team, okay, so that they can be aware, okay, this kind of related party is there. Let's see what kind of transactions are, they are entering into with this related party. Requires management to identify all transactions with the newly identified related party. Inquire as to why entity controls over the related party relationship failed and did not identify this particular related party. Perform appropriate substantive audit procedures relating to newly identified related parties. Reconsider the risk that the other related party or significant related party transaction may exist that are unidentified, and if the non-disclosure by the management appears intentional, then assess the fraud risk factors. So if you think there is an unidentified related party, then first of all, ask management why that was not disclosed earlier. Inform your team. Perform substantive audit procedures for the newly identified related party. Okay, and consider whether there was a hiding by the management was intentional. If intentional, then whether there is a chance of fraud risk factor. So you need to evaluate the fraud risk factor. That is SA 240. Then, when you are inspecting the underlying contracts or arrangements, and you need to evaluate whether what is the business rationale behind this transaction, why this transaction was entered. Assess the indication of fraud risk in the transaction. Let's say, for example, this one, sale of fixed asset. Now, when the sale happened, the fixed asset was sold as a scrap. As a scrap, it was sold. Now, when auditor went and checked in detail, it came to know that this particular fixed asset was bought in 2020 and sold in 2021 within 1 year. Plus, there are no indications / events that can render fixed asset as an scrap. Let's say there was no fire, no damage, nothing such incidents or event that have been reported, which can point that okay, there was a the fixed asset became scrap. Now, in that particular case, it comes to the question to the sorry, it comes to the business rationale behind selling the fixed asset. Why fixed asset was sold? Okay, the business rationale, and that too as a scrap. So you are questioning the rationale of the transaction and evaluating whether there is any fraud in this particular transaction. Let's say, for example, the fixed asset was purchased at a high amount let's say it was purchased at, let's say 25 lakhs, sold at rupees 2 lakhs to show, let's say, capital loss. Okay. And that capital loss can be set off against any other income or whatever. Some sort of planning. Or let's say this is long, let's say this is not 2020, but this was 2015. And this was long-term capital loss. Okay. And accordingly, they wanted to settle something or something like that. Any fraudulent transaction was entered. Or let's say, for example, this was entered in 2015, sold in 2 lakhs, but having a market value of 25 lakhs, so that this particular company can have the fixed asset at a cheaper rate. It can be, okay, this is a limited company. This is a private limited company. So you can say this is a cycling of fixed assets from one company to another. Anything can be there, the underlying transaction. Then you need to understand the terms of transactions, whether they are consistent with the management explanation. Transactions, whether the transactions have been, appropriately accounted as per the financial reporting framework and has been appropriately disclosed as per the financial reporting framework. You need to obtain sufficient and appropriate audit evidence that the transaction have been appropriately authorized and approved, including requirements of Section 188 of Companies Act. So if it is a company, then you need to consider the requirements of 188 also. Then you need to evaluate management assertion related to the arm's length price, whether the transaction was carried out at the arm's length price or not, and evaluate with the presentation and disclosure of related party transaction as per the applicable financial reporting framework. Once you perform all these activities, then you need to obtain a written representation from the management that they have disclosed to the auditor, okay, and the identity of the entities, related parties, and all the related party relationship and transaction of which they were aware. Second, they have appropriately accounted for and disclosed such related party relationship and transaction in books of account. So this is what you are required to do with respect to the related party transaction and relationship. Any doubt? If transaction, so okay, very good. If transaction is with government, then is there any exemption of related party clause? So are you looking for exemption here or are you looking for exemption in company side? See, when I talk about related party relationship, if there is a company which is a only limited company, if that company enters into a transaction with a government company, there are very less chances that that company could be a related party, unless there is not a joint venture between that limited company and the government. But even if that is a related party, then accordingly you need to see all these conditions. So as we talk about the standard, it does not provide any exemption when there is a company, related party company as a government company. Rather, when dealing with government companies are there, let's say for example, if you are dealing with government authorities and government companies, at that point in time, you need to be extra careful because the chances of fraud risk increases at that particular point in time. So you need to consider accordingly that whether while you dealing with the government companies or entering into a transaction with the government company, you need to consider all the areas. Any other doubts? No, it's not like that. So the question is whether the written representation received from management, if it is received from the management, then can auditor is unable to qualify audit report with any misstatement relating to related party? No, no. So it's pretty simple. If you identify any misstatement, you need to evaluate the misstatement. Okay, assess its impact on your opinion, and then accordingly you need to decide whether you need to modify the opinion or not. Now let's come to the area where the management has provided the representation which is wrong. You identified a misstatement, management gave representation is now wrong. This wrong representation, you need to disregard, you will not consider this representation. Plus, all the representation in whatsoever area management has given to you, you will consider the impact of this particular onto those representation. Means what you will do is you will see in this case management gave me representation, but it became inaccurate or incorrect. Are there chances that those representations where we have relied upon the management representation can be inaccurate or incorrect? So the impact will have on the other representations. So auditors still can qualify if the misstatement is material. Any doubt? Okay. Let's see some questions on this particular topic. BBA and Associate Chartered Accountants were appointed auditor for Messrs. Related Company LLP. The engagement manager of the audit team, while designing the audit response to the assessed risk, concluded that there are no requirements of the applicable financial reporting framework for disclosing the related party transactions in the firm's financial statement, and hence the audit team are not required to perform any procedure with respect to identification and disclosure of related party relationship transaction in the financial statement. Okay. So the thing is that engagement manager concludes that there are no requirement of applicable financial reporting framework for disclosing the related party transaction in firm's financial statement. Okay, and hence the audit team are not required to perform any audit procedure. So you tell me, let's not go to the options first. Okay, you tell me if there is no requirement of the financial reporting framework with respect to the disclosure of related party transactions, can we skip testing related party transactions? Can we skip the related party transaction testing? If there is no financial reporting framework requirement for disclosing the related party transaction, no requirement of financial reporting framework, then can we just ignore or do not test the related party transactions, because there is no requirement of financial reporting framework, and hence accordingly there will be what can be the impact. So can we skip the testing of related party transaction? Come on, guys. Absolutely correct, Manali. Absolutely correct, Shailendra. See, when the related party relationship is present, okay, even when there are no requirements of financial reporting framework or very minimal requirement of financial reporting framework, we cannot skip related party transaction testing or complying with this particular standard. Reason because two things. As an auditor, we need to understand or we need to gather evidence, okay, whether the financial reporting financial statement, not reporting, whether the financial statement which are affected by related party transactions which are affected by related party transaction achieve a true and fair presentation and are not misleading. So usually we call it fair presentation framework and compliance framework. So we ensure the compliance, we ensure whether fair presentation framework and compliance framework has been achieved or not with respect to the related party transaction. And when I talk about fair presentation framework with related to the related party transaction or relationship, okay, means that the entity achieves a true and fair presentation of their financial statement. And when I talk about compliance framework, okay, compliance framework talk about misleading, disclosures. So, for example, if there was a requirement of disclosure and we do not disclose a related party transaction, then it may happen that we are not complying or that becomes a misleading. Let's say, for example, our majority of the revenue in a related in a financial statement for a company was from related party. Majority of the revenue. Okay. Now, if we do not disclose that particular detail in the financial statement, it can be misleading. It can be misleading. And hence, accordingly, we need to understand what is not misleading and how we can ensure that, not disclosing or what is an appropriate disclosure of related party transaction, even when there is no requirement of financial reporting framework. So that's why it doesn't matter whether your financial reporting framework is, prescribing any, requirement or not. You need to test. However, if there is a requirement of financial reporting framework, you need to test more. You need to, look after for more areas. But this is the minimum that you need to look for. So let's see the options. Even if the financial reporting framework established minimal or no related party requirements, the auditor nevertheless needs to obtain an understanding of the entity related party relationship and transaction and should sufficiently be able to conclude whether the financial statements so far as affected by the relationship and transaction achieve a true and fair presentation and are not misleading. So the fair presentation framework and the compliance framework. In second one, the auditor is not required. Hence, it's not applicable, not correct. In third one, it says that even if the applicable financial reporting framework established no or minimum requirements, The auditor nevertheless needs to obtain an understanding that the entities, related party relationship and transaction, and should sufficiently be able to conclude whether the financial statement as in so far hold free from materially related party transaction. So tell me, I'll tell you 1 and 3. 1 is a right, 3 is not right, 3 is incorrect. You tell me why. So I'll tell you 2 and 3 and 4 are incorrect. You tell me why 3 is incorrect. That's very important to understand. Why 3 is incorrect? Why option number 3 is incorrect compared to the 1? Okay, Manini. Okay, Shailendra. See what 3 talks about. 3 is talking about that auditor needs to obtain understanding that entities, related party relationship and transactions. Okay, understanding of this, and should sufficiently be able to conclude whether the financial statement as a whole are free from all the material related party transactions. Free from. Our responsibility is not to free the financial statement from all the material related party transactions. Okay, our responsibility is not to free, or management responsibility is not to create a financial statement that should not contain any related party transaction. So 3 talks about whether they are free from all the material related party transactions. That's not required. You can have related party transactions. Related party transactions doesn't mean that they are misleading. So you need to understand from that point of view that it talks about freeing all the related party transactions or removing all the related party transactions from financial statement. And hence, only 1 is correct. Clear? Any doubt? Any doubt? Let's take one more question. Mr. X, while conducting audit of PQR Limited, comes across certain transactions which, according to him, are significant transactions and related significant transactions with related parties, and identified to be outside the entity's normal course of business. Guide Mr. X with example of such transactions to understand the nature and significant transaction outside the entity's normal course of business. So you need to provide some examples. Pretty simple. So if you go and see the examples, and what examples can be? Complex equity transactions such as corporate restructuring, these are not normal course of business. Transaction with offshore entities in jurisdiction with weak corporate laws. Leasing of a premise or rendering management service by the entity to another party if no consideration is exchanged. Because in kind, I give you service, you give me service. Sale transaction with unusually large discount or returns. Transaction with circular arrangement, for example, sale with a commitment to repurchase. Sale and lease back. Transaction under contract whose terms are changed before expiry. So these are certain complex transactions with related parties that are outside normal course of business and that may require some additional consideration. Clear? Let us see one more. While formulating the audit plan and responding to the risk of material misstatement identified and assessed in the related party transaction and relationship, Ms. K, the engagement manager of the audit team of ABC Limited, decided to rely upon the internal control placed for identification and disclosure of related party relationship and transaction in accordance with the applicable financial reporting framework. Okay. Then you are requested to guide Ms. K regarding the necessity to test the control to obtain sufficient and appropriate audit evidence. Also guide whether Ms. K can use the audit evidence obtained regarding the operative intent of the control on identification and disclosure of related party relationship transaction in interim period. See, this does not only talk about one particular standard. Okay, this is a very good portion which deals with the application of SA 330 with my SA 550. Let's see. As per SA 550, related parties, according to the para on responses to the risk of material misstatement associated with the related party relationship and transaction, the auditor should design and perform further audit procedures to obtain sufficient appropriate audit evidence about the assessed risk of material misstatement associated with the related party relationship and transaction. Simply means that auditor should design and perform audit procedures. Okay, auditor should design and perform audit procedures so that he can obtain the evidence regarding risk of material misstatement associated with the related enterprise. So you design audit procedure, you gather the evidence, and then see whether there is a risk of material misstatement or not. So design and perform audit procedures to gather sufficient and appropriate audit evidence so that you can assess risk of material misstatement and you can come to a conclusion for risk of material misstatement with respect to related party transaction or relationships. Simple. Then SA 330, the auditor's response to the assessed risk, talks about that the auditor shall design and perform tests to control, obtain sufficient and appropriate audit evidence to the operating effectiveness of the relevant control when the auditor's assessment of the risk of material misstatement at the assertion level includes an expectation that the controls are operating effectively, okay, or the substantive procedures alone cannot provide sufficient and appropriate audit evidence at the assertion. Then the next question was whether, whether Ms. K can use the audit evidence obtained regarding operative effectiveness of the control or identification and disclosure of related party relationship and transaction in the interim period. So I obtained some evidence in the interim period. Can I take comfort over that evidence as of now at the time of period end? So Ms. K shall design and perform test of control to obtain sufficient and appropriate audit evidence as to operating effectiveness of the relevant control, as she intends to rely upon the operating effectiveness of the control in determining nature, time, and extent of the substantive procedure. Further, she is also required to obtain the audit evidence about significant changes to those controls subsequent to the interim period, along with the additional audit evidence to be obtained for the remaining period in accordance with the requirements of the standard of auditing as discussed above. That is what SA talks about, that when you are testing on the interim period, okay, Auditor is required to obtain audit evidence regarding significant changes to those controls subsequent to the interim period. Second, determine the additional audit evidence to be obtained for the remaining period. So if you do these two things, then it's fine. You can take comfort over the control that was tested in interim plus the additional information that you have get. So accordingly, she needs to perform these two activities, and if she performs, then she can take comfort over the testing which is performed during interim period. Clear? Any doubt? Any doubt with respect to this question or any question with respect to SA 550? Okay. Due to the limitation of time, I will not be able to start SA 560 and 570. Both are very important as one talks about the subsequent event, okay, and another talks about your going concern, okay. Very, very important standards, very important. So in next lecture, what I'll do is I'll cover these two standards and then we will move to 600 series. Okay. Also, I will be dealing with the questions of these two standards, and whenever whatever 600 standards I'll be taking up, I'll be dealing the questions of 600 standards. So I'll suggest please read through all these two standards in detail and the 600 series. So we will continue in the next lecture. I'll be taking up the questions and the standard. That will be if you read in advance, that will be really, really helpful for you to understand because they are very critical and very important standards. Also, please provide your feedback. It's very important to me to understand, whether you are liking the lectures, you need something else, you need further anything from our side, so that we can provide to you. So please provide your feedback. It's very important. Okay. If no further questions, then please go through whatever we discussed today after this lecture, whenever you get time. And before next lecture, be prepared with your questions if you have any. I'll appreciate if you can even ask questions from the previous topics, like previous essays. I'll be happy to take those questions. So don't hesitate. Ask as many questions as you can. Okay, guys. Thank you. Thank you very much. I'll see you in the next lecture. Have a nice day.